Hello, Edyard Denny here. It's Mother's Day, Sunday, May 8th, Mother's Day. I've had to pre-record for the second week in a row. Last week, my wife and I took a little anniversary vacation last weekend and couldn't tape it on Monday of last week. And this Monday, I will be in Vegas, baby. I'm going to be speaking at the Money Show, going there Sunday night. And don't think I'll be doing any gambling. Watching the stock market is enough for me. But I will be spending some time Monday in Vegas. And then I go to California and visit our accounts in Newport Beach. And then I'll go up to LA and then San Francisco and round out that trip and come back home. But I did want to pre-record my comments. I didn't want to get up that early in the morning to record my call for Monday. But let's talk about things. There's lots to talk about. Clearly, everybody's nervous about the stock market. It had a volatile week last week. On balance, it was basically unchanged for all the volatility. On the other hand, from the January 3rd high, we are down 14%. So we're still in correction territory, but it wouldn't take much to be officially in a bear market. Only 6 percentage points more would get us to a 20% correction, which 20 to 30% or more is considered to be a bear market. It's pretty clear what's going on here with bond yields going up so rapidly, the 10-year soaring and even the 2-year soaring. The markets have already kind of anticipated what the Fed's going to be doing. So for all the talk that the Fed hasn't even really started tightening yet, the fact of the matter is the markets have been tightening. My friends, the Bond Vigilantes are doing it this time. And by the way, the Bond Vigilantes back in the mid 80s and back in the mid 90s also pushed bond yields up, and the economy slowed, as did inflation, without a recession. Just something to keep in mind. But clearly, investors are re-rating valuation multiples to the downside. A lot of that's occurring in the S&P 500 growth mega cap 8. That's where we've seen a lot of the re-rating, and it's not just about higher interest rates. Let's face it, they've been disappointing. A lot of them have provided their own bad news and taken some of the air out of their valuation multiples, and that's had a huge impact on S&P 500 growth because the mega cap 8 account for now about 45% of the market cap of the S&P 500 growth, and they still account for about 23% of the overall S&P 500. So we have seen the valuation multiples come down a lot. And I've been really thinking about, and I addressed this issue in a Mother's Day quick take. I hope you're seeing that. I hope you like it. The quick take kind of posited the question, is it possible to have a bear market in the stock market that is just PE led, with earnings continuing to go straight up? I mean, I'm looking at S&P 500 revenues and earnings, and both of them on a forward basis are at all-time record highs right through the end of April. And so the analysts obviously didn't get the recession memo. But the question is whether the drop in the valuation multiples, all attributable to what investors are willing to pay as a multiple for earnings estimates of the analysts. Obviously, they're willing to pay less and less. How much of that is because bond yields have gone up and have kind of reduced the present discounted value of future earnings, future cash flow? And how much is that results from the fact that rising interest rates have made everybody very jittery about the possibility of a recession? It's kind of hard to know. We will certainly know that if a recession actually unfolds, but I'm not in the recession camp. Maybe you are. In any event, if this turns out to be a PE-led bear market, I guess it might be reminiscent of 1987 in a more slow motion kind of way. Back in 1987, we had a bear market, but it occurred very quickly while earnings expectations continued to rise. So maybe there's some similarities there. But I guess it's conceivable to have a bear market with the PE dropping enough to cause the S&P 500 to drop 20% from its January 3rd high. But if we don't have a recession and earnings continue to go up, and earnings are getting lifted not just by the economy continuing to grow in real terms, but obviously inflation is also key here. We know that revenues are always going to reflect inflation. The question is earnings. And so far, it seems that the analysts are saying that companies are, in fact, able to pass through their costs straight into prices. So profit margins are also remaining at record highs. All this is actually foreshadowing what I'm going to be writing for Tuesday's morning briefing. As for Monday's morning briefing, what I wanted to discuss is inflation, the Fed's relationship to that issue, and the Bond Vigilantes. So let's look at some charts here from Monday's morning briefing. So here we go. May 9th is what the date is on the morning briefing. I think most of you are also getting an advance copy on Sunday. So I hope you didn't read it during Mother's Day. Your mothers will be upset if you did. But look, Fed Chair Jerome Powell last week in his press conference said that he sees a soft or softish landing in the economy. He thinks he can accomplish that. And of course, if he says that, it's immediately disputed by all the Fed watchers out there who are smarter than the Fed. And they say the Fed always gets it wrong. I try to be a little bit more objective about it. The fact is, Powell said that the economy is doing pretty well. The labor market's very tight. The consumers' balance sheets are in good shape. Personal saving is accumulated. Balance sheets of corporations are very strong. I don't really disagree with any of that. I also think that it's very unlikely we're going to have a credit crunch that causes a recession, which is the typical reason why we get recessions. But there's a lot of people out there saying we're already halfway to a recession, with real GDP being down slightly in the first quarter. Now, I don't know, that first quarter was kind of a funky quarter. We had the COVID wave in January. We had the Ukraine war. We had the record trade deficit. And yet final demand was still growing. Consumer spending, as well as capital spending, was still growing, something around 2.5% for each one of those. So that's not the makings of a recession in my mind. But yeah, technically speaking, if we get a decline in real GDP in the second quarter, it'll be 2 quarters in a row. But the question is whether the dating committee of the National Bureau of Economic Research will actually view that as a recession. They won't tell us that for months afterwards, so we can debate on whether that was or was not. But look, here's figure 1, shows what Powell is counting on. He's pointing out that job openings are at a record high of 11.5 million. And the number of unemployed workers is about 6 million. And so I think what he's trying to do is try to reduce this job openings or the hirings that occur when job openings are actually filled. So he wants to bring that down, and he thinks he can do that without pushing the unemployment rate up. I mean, good luck with that. Though I am rooting for him, and I think it's a possibility. But I think any measure that really slows down hiring is bound to have some impact on the unemployment rate. But you may be right; it may not be that severe and not enough to actually cause a outright hard landing, and maybe it could be a softish landing. Figure 2 shows the ratio of the available jobs to the number of unemployed workers. And there again, you can see that the labor market is hot as can be, where there's 2 job openings for every unemployed worker. And again, he'd like to bring that down without necessarily causing a recession. Well, a lot of people are saying the Fed is so far behind the inflation curve that they're going to be forced to raise interest rates dramatically, and that'll cause a recession. A few Fed officials have recently countered that, well, wait a second, our forward guidance has been the way we've been tightening more aggressively than is evident in the Fed funds rate. And they're kind of right about that. Look at the bond yield up from 0.51% in July 31 of 2020 to over 3% currently. The two-year Treasury note a year ago was like 0.15%. Now it's 2.8%. So there has been quite a bit of tightening. The mortgage rate's over 5%. So there's been quite a bit of tightening that's occurred. It's kind of my friends, the Bond Vigilantes, have been kind of liberated here by the Fed saying that they're now in a tightening mode and that they're not going to be buying treasuries and agencies anymore. And as soon as they got liberated, they went for it, and they went for bond yields over 3%, mortgage rates over 5%, and so on. So the credit system has tightened without a financial crisis so far, and I think we could have something blow up, but I don't think it's going to lead to a credit crunch and a recession. Well, how about this notion that the consumers really aren't doing that well when you look at inflation-adjusted incomes? Well, this is before inflation adjustment. This is our world famous earned income proxy. It's just a proxy that we put together of what wages and salaries in aggregate are doing. And you can see it's highly correlated, not surprisingly. So it reflects wages, it reflects hours, and the number of people employed. And by the way, this is the way that the Bureau of Economic Analysis calculates this series. We found out a while ago. So this looks great, and it's up 10% on a year-over-year basis. CPI is up 8.5%. The deflator's up 6.5%. So there really is increases in real wages. Looks like they've kind of stalled out here when you look at it kind of on a month-to-month basis. But there's still an upward trend here. The employment numbers are still strong. And all in all, I wouldn't say that consumers no longer have any growth in their purchasing power. And meanwhile, the other story that the bears have been telling, the pessimists have been telling, is that look at the savings rate. It's down to a measly 6.2%. And I guess if you kind of go back here, it's the lowest since around 2015-16. Yeah, I guess that's bad. But look at what the savings rate was before that for the past 2 years. And one way to see how much has been saved is to look at, well, this is the annualized rate. Again, doesn't look so great. Doesn't look terrible. I mean, it looks kind of like back to normal. But look at the 24-month sum of personal saving. And you can see that the consumers have saved at $2.5 trillion. And a lot of that's still there. It's liquidity that the consumers have. When you look at M2 over the past 24 months is up remarkably. It's up $5.8 trillion. So clearly some of that liquidity is reflected in personal saving. Some of that is reflected in liquid assets sitting on the balance sheets of corporations. Corporations, as I've pointed out, this is M2, let's skip that. This is not because it doesn't support the story, but we've seen it before. You've seen this chart before as well. This is the 24-month net new borrowings in the non-financial corporate bond market. And you can see that that's $2.3 trillion. So there's a tremendous amount of liquidity that's been accumulated and refinanced debts over the past couple of years. And so again, I think consumers, I agree with Powell, consumers are in good shape. Meanwhile, as you can see, the Bond Vigilantes have been acting up a bit. This is actually a very unnerving chart. When I looked at it again, I said, "Oh, geez, I hope this isn't what we're heading towards." But I have to show it to you, and we have to be cognizant of the fact that when you look at the 10-year Treasury bond yield, it's actually had a pretty consistent history of the bond yield being well above the inflation rate, well above the GDP inflation rate. Here, when the Fed was doing all this rigging of the bond market through zero interest rates, ZIRP, and through quantitative easing, in all those cases, we had a situation where they were pretty close and at very low, historically low levels. Now, all of a sudden, we got this pickup in inflation. Does this mean, as some super bears and pessimists are saying, that we've got to see the bond yield go to 6, 7, 8, 9% in order to bring inflation down? I'm not in that camp. I'm thinking that 3%, 3.5% may be it, because I think inflation is peaking right now and will come down without a recession. I'll admit that's a very contrary view, become increasingly contrary of late. Remember when we were like at 2% on the bond yield or below 2%, people said, well, we'll get to 2%. When we got to 2%, they said, well, maybe we'll get to 2.5%, and bam, we're at 3%. Now everybody's talking about 4, 5, 6% on the bond yield. And it's conceivable that the bond vigilantes will do that and cause a recession, and it won't last very long, or it be a soft landing. As I said, they've done it before. If you look at this chart, take a look at the mid 80s, where we had this backup in the bond yield here and here, and arguably this is when the bond vigilantes kind of first started to take over, or express their opinion of whether fiscal monetary policies were doing the job, and if they weren't, they were going to do it, the job of keeping inflation down. And then in this mid 1990s period, we had a period here where yields went up for a short period of time, and yet inflation continued to move down. Obviously, there could have been plenty of other factors at work, but we've shown you this chart before. This is our latest forecasts for headline and inflation. We show you core as well. Core looks like it may be peaking. We'll see how that plays out. We looked at the components, and we think there's an argument to be made that's the case. But the headline, on the other hand, has still food and energy in it, and that it's hard to get optimistic at this point on that. But we're looking for 3 to 4%, 4 to 5% here, and then 3 to 4% next year. I went out on a limb and said, if we're going all the way up to 2024, I think we could get back to 2%, and that'll be based on this optimistic scenario that I still think has a chance, and that's the roaring 2020 scenario, where productivity makes a huge comeback, unlike the 1970s where productivity collapsed. So let's look at the inflation story a little bit more closely here. This is the average hourly earnings data that came out with employment on Friday. And here you can see that the year over year was a little unsettling. It's still high at 5.5%. It hasn't gone up. It's kind of stabilized here. But what's encouraging is that we think that if you compare the 3-month annualized rate to the year over year, you get some idea of where the year over year is likely to go. And you can see there's been some moderation here in the 3-month down to 3.7%, which is a moderation for sure. And it's below the year over year. So I think that's an argument for maybe we're starting to see some peakishness in the wage numbers. The same thing for goods. You can see that that's come down to 4.1 below the 5.2, some progress, and 3.6 down to 5.6. I know some of you will say, well, that's not progress. I mean, if consumers are getting slower wage increases relative to inflation, that's bad for real incomes. But I'm arguing that they're clearly related, and that price inflation should also be coming down if labor cost inflation is coming down. So let's look at the consumption deflator, which came out, I guess, a week or two ago, and look at the core PCED excluding food and energy. We'll look at food and energy in a second. You can see, again, we're seeing some moderation here, 4.2 versus the year over year of 5.2. So maybe that's a peak. Look at durable goods. That's been my story, that a lot of the inflation, the double-digit inflation we've seen here has been related to durable goods, particularly autos, but also furniture and appliances and so on. And that certainly looks peakish. You look at 2.5. I mean, that's good. That's a good number down here. And the annual is 10.2. Look at the non-durable goods, excluding food and energy, and you can see that there's a problem there, excluding food and energy. That looks like it's going to go higher. On the other hand, services looks like it's getting tamer, but rent is a problem, as I'll show you right now. This is rent of primary residence. We know that rent is a slow-mo kind of inflation number, because whatever you're seeing is current rent inflation, and currently it's high. It's 12 to 15% on new leases, and that's going to take 12 to 24 months to be reflected in all leases, assuming it kind of stays at this level. It could moderate clearly, but for now, you can see that the 3-month is well above the year over year. The 3-month is 4.2 for tenant rent and 4.4, and obviously that affects the owner equivalent rent. So if we do in fact continue to make progress on durable goods inflation, some of that could be offset by rent inflation, but not all of it. This is, of course, there's some unsettling news saying that there is no peak yet in inflation. The productivity numbers that came out last week, I think it was on Thursday, That was the day the market took a big dive. And it took a big dive because at the beginning of the day, productivity came out and was down sharply, and unit labor costs, as you can see, were up 7.2%. And that correlates quite well with a year-over-year percent change in the CPI. So they're just confirming one another that there is no peak yet in the inflation rate. So it's still a sort of a mixed picture, though I would point out to the unit labor costs, as you can see, are very volatile, not just on a quarter-to-quarter basis, but also on a year-over-year basis. And some of that disappointment in productivity in the first quarter, I was disappointed, but not overly. Real GDP was down in the first quarter because the trade deficit was all-time record high. We had the COVID issue, but final demand was still pretty strong. So I'm not convinced that this is the beginning of the end of the productivity growth story. I think it's still very much intact, in my opinion, based on what I see companies doing with capital spending, technology, and how they're reacting to labor shortages. Meanwhile, another indicator says we're no peak yet is the ISM prices paid indexes. For non-manufacturing, rose to an all-time record high. That red line in manufacturing remained very high. Let's look at food and energy, because I can't really ignore those. Everybody's complaining about food and energy, and there's no relief in sight there. There's no peak there yet. So you can see that food on a 3-month basis is 14.9% annualized, while the year-over-year is 9.2%. And energy is even uglier at 68.8% annualized versus 33.9%. But these are largely driven by commodity markets. They're very volatile. And what goes up can come down, though it's hard to see what's going to make food inflation come down anytime soon. Right now, it looks as though the prospects are for more trouble going into the summer, certainly on a global basis. And energy, let's look. Last week was not a good week for the outlook for inflation based on energy. As you can see, while the West Texas intermediate stayed around $110 a barrel, it didn't fly up the way that we saw heating oil and gasoline and diesel go soaring. And I think some of this reflects the fact that the U.S. is scrambling to export refined products to Europe because of the Ukraine situation and the attempts by the Europeans to become quickly less dependent on Russian energy sources. And the same thing can be said here for natural gas. So that's it. That's a quick review of the morning briefing for Monday and a hint of what we're working for on looking at the relationship of the equity market to inflation and PEs and inflation and earnings. So we'll have more for you, continuing to expand our views on all that as we do more research. So have a good week. I'll have to look at my calendar, but I think I can sort of promise you that this will be live next Monday, so we can go back to do some Q&A. Again, thank you very much. Have a good week.